Welcome back to this week's market update. Today is Monday, September 22nd, 2025, and we will jump right in. Looking at performance from last week, stocks made new all-time highs as investors welcomed the Fed's first rate cut in 9 months. Strength in technology stocks powered much of the rally, with the Nasdaq Composite up 2.2% last week, followed by the S&P 500 up more than 1.2%, and the Dow Jones Industrial Average up a little more than 1% last week. Moving into last week's market news, we did get the Federal Reserve September meeting last week where the Fed announced their first rate cut since December of 2024. So nearly 9 months of no rate cuts here, and that brought the target rate range to 4 to 4.25% for the Fed funds rate. Now, the 25 basis point rate cut was largely as expected, but what was a little bit less certain was the SEP, the Summary of Economic Projections. These are quarterly estimates that the Fed puts out of things like economic growth, unemployment rate, inflation, as well as the federal funds rate here. So looking at how those changed over the last quarter, we can see that the Fed is now expecting slightly higher economic growth than they were 3 months ago, although it's still slightly below trend expected for 2025. The unemployment rate is expected to be stable as it was 3 months ago. However, it was revised slightly lower for the following year, so that's a good sign there. Inflation expectations were also stable through year end at 3 and 3.1% on a headline and core basis, but we did get a slight revision up in the expectations for 2026 there. Last but not least, looking at the federal funds rate, this is the one variable that they can directly control here. The Fed is now pricing in 2 more 25 basis point rate cuts or one larger 50 basis point rate cut by year end, which would bring the median Fed funds rate to 3.6%, about 30 basis points lower than it was 3 months ago for expectations. So lots of changes in the Summary of Economic Projections here, the largest being that the Fed is now expected to cut rates further by the end of the year, and that trend persists through 2026 and 2027 here. In addition to the Fed meeting, we got several other important economic updates last week, including August retail sales. They came in much better than expected at a monthly growth rate of 0.6%, and this was up 5% from a year earlier. So a really strong month of retail sales. Spending showed notable strength online with non-store retailers, which largely includes online shopping, rising 10.1% year over year and 2% in just the month of August alone. Restaurants also posted healthy growth with sales up 0.7% in August and up 6.5% compared to a year ago. However, we did see some softness in the general merchandise category here. This was down a slight 0.1% in the month of August and up a very slow 1.9% from a year ago. Overall, though, August figures show that consumer spending remains pretty resilient, even as other parts of the economy begin to show signs of cooling. We also got the Conference Board's leading economic index last week. It showed that the index slipped 0.5% in the month of August, which was the largest monthly drop since April. This was caused by a pretty widespread drop in leading indicators here. So you can see 2 positive indicators, the leading credit index, the S&P 500. Those were both pretty positive in the month. Several neutral indicators you can see, like the yield spread, the new orders on both the non-defense and the consumer goods here. They were both pretty neutral. And then besides those factors, everything else was pretty broad spread weakness. So you can see initial claims were weak, average weekly manufacturing hours, building permits, the ISM New Orders Index, as well as consumer expectations. All of these led to a weaker month in August. So we did get a recession signal triggered again in this LEI, but that has been triggered several times since the post-pandemic recession, and we've yet to see a true recession, which is 2 negative quarters of GDP growth. So we are seeing a lot of negativity in leading indicators, a lot of bearish indicators, but we've yet to see, the actual results of that economic slowdown to a severe effect. Last but not least, just touching on a quick conversation of regulation in U.S. securities markets here. President Donald Trump recently suggested that U.S. companies may want to consider moving from quarterly to semi-annual earnings reports, a change the SEC is reportedly discussing. Now, many developed markets like the UK, like a lot of Central and Western Europe, as well as some parts of Asia, already do this. Supporters say that this could cut compliance costs and allow companies to focus on longer term goals. On the other hand, critics point out that quarterly reporting gives investors more timely information and can also improve analyst coverage and forecast accuracy. Now, there has been no decision made, but any shift would definitely be very impactful in US securities markets, as so much of the cadence and the speed of US financial markets is around quarterly reporting. So, very interesting, just a change we want to be aware of, a potential change we want to be aware of in US regulation. So that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.